Welcome, empowered investors. This is episode 2059. And today I would like to talk about the 1% equals 10% rule. Now, I don't need a whole bunch of people writing me and saying, Jason, this is not exact. It's not exact. I'm telling you that at the beginning. It is, though, a rule of thumb. And I think it's a rule of thumb that will really help us think about what we are dealing with when it comes to higher interest rates, or hopefully in the future, lower interest rates, and how it would normally affect pricing. But this time, it did not affect pricing in the way most people thought, except for yours truly. I thought differently, and you can go back and listen to the old episodes and you can see how right I was. Now, this will not continue to be true forever because, of course, nothing lasts forever. It is always a dynamic market, and eventually all of the crash bros will be right someday, but it doesn't look like they'll be right very soon. And the scariest thing of all is the untold damage they have caused to people's lives. They have literally ruined retirements. They have ruined financial futures because these crash bros, these fear porn purveyors, they are out there spouting all of the doom and gloom, and they are causing people to miss opportunities. Most people are not recognizing the dogs that don't bark because our minds tend not to notice what doesn't happen. What we do notice is what does happen, but it's very important sometimes to notice what doesn't happen, because sometimes what doesn't happen could be the most important thing. And what do I mean by this? Well, what doesn't happen in your life? If you missed an investment opportunity, if you were believing in 2015 that the market was topped out because it had a little bit of a run there post Great Recession, right? Had a bit of a run. And if you were thinking the market is topped out and you were listening to all of the people saying that the market is going to crash, you would have missed out on a boom time right up until COVID, when people made lots and lots of money. And then you would have heard a whole nother set of people at the beginning of the COVID era saying the market is going to crash. This is absolutely the worst time ever to be buying investment properties. And if you'd listened to them, you would have lost, depending on how much money you were having to invest and how many deals you might have done. Maybe you would have lost millions of dollars. If you were a bigger investor, maybe you would have lost tens of millions of dollars. These people are literally ruining the course of the lives of tens of millions of people, maybe billions of people, because our mind all loves to tune into negativity and doom and gloom. And sadly, we listen to these people. Now, I'll tell you, I am not immune to this because I seek this stuff out too. And I have been following this kind of news since the 90s. I have been, well, really before that, even in the 80s, this kind of doom and gloom stuff. I remember hearing in the late 80s about Howard Ruff. Okay. And Howard Ruff was on my show, and he had been writing about the apocalypse, the collapse of society coming for many years. He was a gold bug. He told you to store food and store water and do all this stuff. And look, I have another show, as many of you know, called the Holistic Survival Show, protecting the people, places, and profits you care about in uncertain times. I launched that show right around 2008, and I interviewed a lot of these preppers and survivalists and doom and gloomers and the people writing, the thought leaders in the collapse culture. I'll call it the collapse culture there. I just coined a new phrase, the collapse culture, right? The end of the world culture, the doom and gloom culture. And what I realized after doing 256 of those interviews, 256, okay, that, are generally 45 minutes to an hour long each, probably, maybe 45 minutes on average, is that these people have a sickness. And the sickness is that they've confused being responsible and prepping, which is responsible, a basic amount of this. They've confused a task that should be on your to-do list that you check off They confused it with a lifestyle. It's not a lifestyle. It's a to-do item. And once you do it, you're done and you move on and you enjoy your life. The phrase I made up for these folks is they're so busy preparing for the end of the world. They're so busy doing all of this stuff to make sure that they survive, that they live, and they outlive all the rest of the people that are going to die when society collapses and the economy collapses. They're so busy preparing for that they never live in the first place, right? This is a to-do item. It's not a lifestyle, right? I mean, I remember when I was hired to do a speech at one of these prepper survivalist conferences. And I came and I spoke and I talked about real estate and economics and so forth. I just was kind of shocked by some of the people I met and, their whole mentality about this stuff. It's just a strange, it's a form of sickness. Look, I just got back from the doctor. My birthday's coming up. I always try to get my annual physical around my birthday. I had this whole list of like blood work that I wanted from my doctor and all this kind of stuff. I wanted to get this test, that test. Hey, mostly the insurance will pay for it, right? So I want to get every test I can get, right? And just know that I'm okay. And I joked to the doctor about how I was being a hypochondriac, right? Possibly. And this is the thing, this like paranoia. And, when you're into the quantified self sort of lifestyle, right? Where you're monitoring how many steps you take every day, how much sleep you get, you're monitoring this, that, and the other thing, all the smart watches have helped us with all of this stuff. You become attuned to this and it's good. It's good to become attuned to that, right? But you can go too far with anything. Look, hypochondria is a sickness. Well, why wouldn't survivalism and prepping and fear porn consumption be a sickness too, right? It is. I'm here to tell you, it is, right? Do the responsible thing and be ready, but don't make it a lifestyle. That's my point. So when we talk about the economy and the real estate market, let's take a look at this rule I have, the 1% equals 10% rule. And I want to start by first telling you that our sponsor today is Empowered Investor Pro. And we have our meeting tomorrow night, our monthly Zoom meeting. These are so great. This is the best deal you can get in the real estate education world. So join our Empowered Investor Pro community. Go to empoweredinvestor.com and join that. Okay, so first I want to start with this little short clip where we edited down one of my prior videos and just share this with you as to how to think about the market. Then let's take a deep dive into this. Here we go. We are simply in a massive shortage. So if everybody listening just pictures their kitchen sink for a minute and think about if your sink were full of water, we'd call that a normal market. A bad market would be where the water's overflowing. So right now, your sink, if you're comparing it to the market, is about 40% full. It's 60% empty. That's the amount of inventory we have. Let's look at two more components. The faucet represents new homes coming on the market, and the faucet is just trickling. Barely anything is coming on the market. And the drain represents the buyer demand, and so that is how many buyers are buying properties. Now, the Fed has demand as best it could, but demand is down by about 20%. If it were a booming market like we had, the drain would be fully open. Right now, it's about 20% clogged, less demand, and the faucet is at a trickle, and the basin of the sink is only 40% full. That's where we are. Probably won't last forever, but there's a lot of evidence saying that it'll last a long time. Okay, so this is to explain why what most people thought would happen didn't happen. Okay, so I'm leading up to it. Okay, here we go. Our friend Joe Brown, who spoke at our Empowered Investor Live conference in Scottsdale, he made an interesting post on, I don't want to say Twitter, but X, on X. And I thought I would kind of go through his detailed post with you. And of course, he's been on the show before. It's probably about time to get Joe back on the show. And I've been on his show too. But here's what he goes over. He says, countless people have been sitting on the sidelines waiting for the next housing crash, so they don't buy at the top, right? Here's why I don't think this is going to happen. Number one, and these are statistics I shared with him on his show. He probably first heard them from me, and they've now floated around into the mainstream, and we've all heard them. You've heard them before, but he recaps them here, so I'm just going to say them again. 42% of all U.S. homeowners have no mortgage. These people cannot be forced to sell. Okay, so we know that there's a lot of people who own their properties free and clear. Remember, as I always say, the one absolutely required ingredient for a housing crash is millions and millions of distressed homeowners that must sell, that must dump their properties on the market. Okay, then he goes over the composition of the other 58% of the houses that have mortgages. Okay, and he did add a little more detail than I usually quote on this. He said that 91% of mortgage holders have an interest rate on their mortgages that is less than 5%. 66% of mortgage holders have an interest rate under 4%. These people will fight like crazy to keep their homes. How many times have I said that, right? And 26% of the mortgage holders have a mortgage rate at or below 3%. Nothing new here. You've heard me say this many times before. And here is a different chart from Fortune that outlines this. You've seen the chart that I've produced with the graph chart. This is a pie chart that just shows you the mortgage composition. And right in here, where we've got our empowered investor superhero, shows you the mortgages of 3.01% to 4%. That's 45% of the mortgage market. Where will the distress come from? That is the question we've got to answer. Okay, these people will not be forced to sell out of their homes unless the economy absolutely falls to pieces, because it would force them to pay much more if they had to rent or buy a new place. Now, I was away last week. I was at 2 conferences. And the first conference, I was speaking on this whole topic, right? Giving my predictions and forecasts about the economy and the housing market. And one of the things I showed, and I'm going to share this with you here on the show, but I showed the detail of how even if unemployment spikes up quite dramatically, it's not going to cause a housing crash. And one of the main reasons for this is that people literally could qualify for the mortgage they have with unemployment insurance. I mean, how often has that ever been true in history? Maybe never. I don't know. I'm not sure. Very amazing. Right? But the other thing that people tend to not notice, in my presentation, I talked about the time machine. And by the way, some detail on this is going to be in one of our email. Be sure you're subscribing to our email newsletter, okay? Just go to jasonhartman.com, fill out any web form. We'll get you on our mailing list because you don't want to miss our email newsletter. I took a bunch of the slides from this presentation. I dropped them into the email that I'm composing now, and I'll probably send that out within about a week or so, okay? So you definitely want to see this because it's got some good data in it. But one of the things I talked about is the time machine and how people are literally, if they got a mortgage during the COVID era, they literally stepped into a time machine and went back in time by about 10 years. But wait, there's more. And I've talked to you about that before, because what they got is, even though the house price is much, much higher, they've got a mortgage payment equal to what it was 10 years ago. But here's something different I did for this presentation that I gave last week. I adjusted it for the official rate of inflation. And based on that, there had been about 27% inflation officially over that time period, right? The cumulative inflation rate. But that's only based on the official rate, the consumer price index, not based on the unofficial rate of inflation, which is much higher, but we won't even go into that. Let's just use the official numbers. Now, what that means is that monthly mortgage payment from just over 10 years ago has been debased. It's been reduced by the official inflation rate. And that mortgage today is actually not equal to what it was about 10 years ago. It's dramatically cheaper than it was 10 years ago, adjusted for inflation. So all of these people have got extremely cheap mortgages. Now, one of the other interesting things about that is I didn't take the lowest rate mortgages, the 25% of the mortgage market, of the existing mortgage market. I took the median mortgage payment, the one in the middle. And still, with those people, they've got a house that is much cheaper to own than it would be to rent a little tiny apartment. You think they're going to give that up? No way. Not going to happen. Okay, so going on with Joe's post on X here. Okay. Also, anything that would force these people to sell their homes would force them to rent, which means massive demand for rentals. I've talked to you about that as well. Remember, if you have not heard it, go to jasonhartman.com and use the search engine there and type in 3 dimensions of real estate. And be sure you listen to my presentation explaining the 3 dimensions of real estate, where It's multidimensional asset class, and you've got the rental income versus the potential capital appreciation and all of this stuff. Okay, just go check that out. Okay, which still means huge demand for housing from investors who are renting them out. Okay, number 3 point he makes: population. For the past 15 years, the rate at which new housing units, including apartments, has increased has been far less than the rate of population growth. Simply, there are more people who need a place to live than there are places to live. Now, I want to tell you something. This analysis is not exactly correct. Here's why. To compare population rate over the same period as home building rates, that is like the typical way that you would look at it, and it's a sort of a layperson approach, and it's fine. But it's actually quite a bit more dramatic than Joe points out, because when you're looking at population, the more important statistic is not population, it's household formation. That's a much more important stat. And how do you know where household formation is going? Well, you need to time lag population growth back by about, normally you'd say about 25 years. But millennials and Gen Zers are a different type of demographic cohort, those two, right? You have to lag back about 31 years for them. The reason is their life stages are about 6 years behind their baby boomer and Gen Xer parents. Okay, so you have to lag that back. So what really counts is not the population growth we had during the same period they were building, or well, when they weren't building homes, right? Coming out of the Great Recession, the last 15 years or so, that has been abysmal. There's been, no home building in the entry-level market virtually at all. The only place really you can find those homes is at jasonhartman.com in the properties section, because as you know, if you shop for a new home that's an entry-level home, they're almost impossible to find. Okay, so go to jasonhartman.com, click on properties, you'll find them there, the good properties that make good sense as rental properties for investment. But you have to lag it back. And what's really important is what happened in the early 90s. All of those people now are in their household formation years, not so much the people that were born over the last 15 years when they weren't building houses, right? That does matter, but it's not nearly as much of a demand creator or as much of an impact on the housing market that has such dramatic shortages as what happened in the early 90s. Okay, so we got that point. Okay, now number 4 point he makes: potential for future interest rates going down. And this is really important. It's a good point. If interest rates go down, there are a ton of people who are on the sidelines right now who've been, quote, waiting for a crash, unquote, that never came. Now they are priced out and can't afford to buy because of rates. So if rates come down, all of these people will become buyers and push up prices again. Good point. Absolutely true. Now, number 5, potential for future rates going up. It is very likely mortgage rates will continue going up. In a normal housing market, this would push prices down. So far, this hasn't happened because of the mismatch between housing units and population. So interest rates have gone up, but that just made housing more expensive. This trend will continue. If rates continue to climb, it will simply price more and more people out of the housing market. If housing prices fall from rates going up, then that just means the cost of buying stays the same. Well, actually, that's much worse than he's pointing out, right? His point is well taken, but it's actually quite a bit more dramatic, because he mentioned it in a prior point about the rental market. That will just simply push more people into the rental market, increase rental demand, and push rental prices up. Remember, multidimensional asset class, you make money either way. Okay, so his conclusion: sitting on the sidelines now is dangerous. Many people have done this and are now priced out. If rates go up, it will price more people out of the market. If prices fall from rates going up, and why didn't that happen? Because of the little video I played for you earlier in today's episode, right? About the sink. The sink hasn't let the prices fall. All these people, except yours truly, were predicting this big housing crash that never, ever came. And it's probably not going to come for quite a long time. It will come eventually, but there's just no evidence that it's going to come anytime soon. Okay. If housing prices fall, many more buyers who are on the sidelines waiting and will keep prices from falling further, right? Because if prices fall, people jump into the market. If interest rates fall, they'll jump into the market and they'll buy. If interest rates fall, prices will shoot much higher. There is a small chance that the monthly cost of buying comes down slightly, but there is a much bigger chance that the monthly cost of buying continues to move higher. Getting your foot in the door now means that the worst case scenario, you have a high mortgage payment for a few years until interest rates come down. Staying out waiting for a crash risks being priced out of homeownership permanently. And you know what? That's exactly right. It has been amazing to me how resilient the real estate market is and how, frankly, how good business has been for us. With these higher interest rates, I really did not think the market would hold up quite this well in terms of our business, right? Yeah, I didn't think there was going to be a real estate crash, and I still don't think that's coming anytime soon. But there is an issue of volume. Volume and prices are two separate things. They do not necessarily track each other. And I have been pleasantly surprised, thank you to all our clients out there, at how good the volume of business has been through these massive interest rate hikes. And that's because you, our audience, our investors, you get it, right? You know that you can constantly renegotiate the deal. That's one of the beautiful things about real estate. As I've said before, when we do a deal with someone, when we reach an agreement to trade with somebody and engage in commerce with them, and if they don't keep their word, if they don't keep the deal, we don't like that. We call them a weasel, right? They're unethical people that backpedal on their agreements. No good, no bueno, right? But in the investment property business, you can constantly change the deal, right? Because you always have the chance to refinance the property and change the deal. And there are many other ways to change the deal as well. So you buy it today, and that's not the deal you're stuck with for the future. So I'm terrible at predicting interest rates. I'll be the first one to tell you I've been really good at my predictions for a long, long time now. And the vast majority of them have come exactly true, just like I said they would. But the one that has not come true is interest rate predictions. So I've been notoriously bad at predicting interest rates. But that said, I will make my prediction on interest rates. I think we're going to see mortgage rates ultimately settle in the next couple of years somewhere into the high fives. Now, that'll be for owner-occupied mortgages. Investment property mortgages will be a bit higher than that. They'll be in the sixes. But it just feels like that's where the market will settle. Okay. And if that happens, that mortgage rate is renegotiated, it comes down quite a bit, and your deal gets better than the deal you agreed to today. There you go. Okay. As we wrap it up here, I just wanted to share something on a personal note. Well, personal and business note. So I did a show just over a year ago about this big case that we won. Myself and two of my companies won in federal court. And that was this competitor who was engaging in unfair competition. They were saying all sorts of lies about me online and all this kind of stuff. Well, we won that case. We got a jury award of just over $50 million originally. And of course, there were lots of post-trial motions and they tried to get the award down. Well, after over a 1-year wait, the court finally made a ruling denying their post-trial motions and securing our jury award that ultimately came in with interest just over $30 million. The court did find initially some of the things were duplicative, and so we weren't entitled to damages for all of them, but that award now is a firm award. Of course, they can appeal, but appeal is a whole nother process. But at least the federal court did decide in our favor, and we secured that judgment over $30 million with interest cost. So that's great. And we are looking forward to collecting whatever we can on this judgment. One of the reasons I tell you this is because I wanted to give you an update on the case. We did a whole video about it where we interviewed our lead attorney on the case, and it's really insightful. I tell you, this could happen to any of you. It could happen to someone you care about. And it's really, really important to know. I call this the crime of our time because anyone can say anything. They don't have to have any proof. They can just make hit and run allegations online, and it can cost you money. It can cost you your reputation. And that's what happened to me. But fortunately, after an 8-day jury trial, the evidence was presented. The jury ruled in our favor, and now the judge ruled in our favor as well. So that was great news. And we're glad that justice was served on this. So just wanted to give you an update on that. But if any of you listening are collection attorneys or have referrals for collection attorneys or anything that might help us with this, please reach out. Go to jasonhartman.com/ask or comment below if you're watching on YouTube. We would really appreciate anything you can help us with there. By the way, on that video, when it was released, look at all the nice comments. I'm so happy for you, Jason. I had no idea you were going through this. Sorry to hear about your struggle over the last 4 years. I mean, it was really tough, folks. This person says it deserves an entire article. Holy cow, what a nightmare. Good guys win. Thank you for fighting back. Not everyone is able to do this, but it's very important. I should also say God bless the state of Florida and the Florida jurors. And congrats, Jason. Jason, I'm so glad to hear that this is over. You do an awesome job at doing research and amazing content. Keep it up. Anyway, thank you for all the kind words. There are many more of them. I can't put them all here, and I don't want to bore you with all of them, but that was great. So, if you're interested in knowing more about this case and preventing this, hopefully, from happening to you or someone you care about, go back and listen to that video or that podcast episode. It's on my YouTube channel or on the podcast. Last thing I just wanted to share with you before we go. Next episode, of course, will be a 10th episode show, but it is this article that I thought was interesting, and it says every generation, in other words, every demographic cohort, we talk about these, the baby boomers, the Gen Xers like me, the millennials, the Gen Zers coming up, right? The article says every generation lost wealth last year except one. An annual assessment of individuals' wealth by Swiss banking giant UBS found that the US got hit harder than any other nation last year. Now, I would actually disagree with that, but I don't know the report, so whatever. The Global Wealth Report says that the total net worth of Americans dropped by nearly $6 trillion in 2022, with 1.8 million Americans losing their status as millionaires, reports Fortune. In fact, every generational group in the US saw their collective net worth decline in 2022, except one: millennials. Okay, here are the millennials, the complainers. All of you millennials, right? All of my millennial friends. You like to complain a lot, but you fared better than everybody else, okay? So the question is, compared to what? The average person born after 1980, but before 1997, saw their net worth rise nearly 7%, compared to the drops of my generation, Gen X, who lost 1.3%, the boomers who lost 1.6%, and the silent generation, or those before 1946, that lost 14.5% of their wealth. Now, you might be thinking, well, that's just so unfair. It's not what you thought. But there's more to the story than meets the eye, right? One of the reasons, of course, here is not because of the system, and because of the way we distribute wealth in the country, right? There are issues there as well, and we've talked about many of them. Like you look at the wealth inequality, the Gini coefficient is how they measure that. So look at the Gini index, they call it, and it tells you about, wealth gaps and wealth inequality. But millennials are in their prime earning years. Well, I should say the geriatric millennials, as they are called, right? The older millennials are in their prime earning years. Right? So of course their net worth should be increasing right now, versus the silent generation and even the baby boomers. Their net worth, they're just mostly investing, retiring, maybe slowing down a little bit in their careers and their businesses. So this is not totally surprising, right? I just want you to know that's an element of this, right? And the article goes on, it says, the millennial secret, real estate. Real estate, essentially, and more specifically, rising home prices compared to the other generations. Millennials have more of their net worth linked to their houses, 37%, instead of, say, the stock market, whose benchmark S&P 500 index fell about 20% last year per CNN. Okay, helping there is that 70% of younger millennials and 46% of older millennials were first-time home buyers last year, according to the National Association of Realtors. Millennials roughly range in age from 27 to 42 years old today, right? One member of this age cohort who just happens to be a financial advisor, said that stats further debunk the myth that millennials are broke and or bad with money. There's solid evidence that millennials aren't actually far behind as previous generations, Kevin Mahoney tells The Messenger. Okay, quote, there's been a narrative going on for 10 to 15 years now about millennials not putting sufficient effort into their finances or complaining too much about their finances. And I don't know if reality has ever backed this up. Well, like I've said before, again, that doesn't tell the whole story either. What tells the story is a 6-year lag in age. So to compare a 30-year-old millennial to a 30-year-old baby boomer parent of theirs is inaccurate. You have to compare the 36-year-old millennial to the 30-year-old baby boomer parent. And so the millennials look at their parents and they say, hey, mom and dad, where were you at age 30? I'm 30, right? Where were you? Well, we owned a house, we were doing great, yada, yada. Well, inaccurate comparison because millennials are on the slow life plan. And so are Gen Zers. They're 6 years behind schedule in everything. They're buying houses 6 years later. They're forming families 6 years later. They're getting married later. They're doing everything later. Okay? So you got to have a 6-year adjustment in there for that. Okay, tomorrow night is another monthly Empowered Investor Pro meeting. If you are not a member of our pro group, you are missing out. I just got to tell you, you're totally missing out. This is the cheapest, best education in the real estate world. I couldn't believe it. I was at these 2 conferences last week, and I cannot believe how expensive some of these educational programs are that these various thought leaders are selling. This is super cheap. This is about $80 a month. Right? Join Empowered Investor Pro. Do not miss out on our monthly Zoom meetings. Sometimes we have them more often. Do not miss out on our social network and all of the great assistance you'll get there. Our library, our huge library of content that's available to you. Just so many benefits of being in Empowered Investor Pro. Do not miss out on that and join the group, Empowered Investor Pro. Go to empoweredinvestor.com and sign up for that right away. All right. We will see you on Wednesday for our next episode, and that is a 10th show episode, and we've got a really good one coming up for you. So we'll see you then, and until then, happy investing.